What's up, you guys? My name's Henry. If you're new, I'm starting a series on options because that's my area of expertise when I was working at Goldman Sachs. And in this video, I'm going to explain to you what are call options, why they are important, how they work, and the benefits, so make sure you stick with me. Before I jump in and flood your pockets with money, make sure you like the smash button for Uncle Henry and subscribe to the dopest YouTube channel. I'm going to start off by explaining buying call options, and in the next video, I'm going to cover selling call options. So first of all, an option is an agreement between two people. Buying a call option is betting on a stock rising, so a call option is just a contract that allows the buyer to purchase 100 shares of stock at the call option's strike price. So a call option is used to buy stock, specifically 100 shares. But what is a strike price? A strike price is the price which you are betting on the stock reaching, or in other words, a strike price is the price at which the option can be converted into shares of the stock if it is being exercised. And if it's above the strike price, you will be exercising because it makes a lot of sense. Exercise, besides sounding like we're going to be lifting some weights or jogging, refers to the action of converting the option contract into shares of the stock. Let me do an example on the whiteboard so you can see how this actually works visually, since we learn visually and I specifically learn with examples. All right, so I drew this example on the board right here. Basically, we have a stock which is $100, okay? And then we have a call option with a strike price of $110. The reason we're buying call option is because we think that the stock is going to go above $110. So this stock, if it reaches above $110, gives us the opportunity, the right to actually buy the stock at $110. What happens below $110 is, well, we don't have the right. We're not going to actually exercise because we are not making money. At $110, we are at the money, or we're beginning to make money. So essentially, when a stock rises to 110 or above, the point of a call option is we buy the call option and we bet on this strike price. Here's why this is important. Buying a stock that is $100 costs $100. Buying an option betting on a stock going to 110 may cost something like $2. So instead of spending $100, you can control 100 shares of stock by buying a call option that is like $2 or something very inexpensive. $2 versus $100, you have much more leverage and you control the same amount of shares. So Henry, you're telling me that I can control stock for just $2? Well, yes, essentially you can. Just one thing though, since each option represents 100 shares, if an option is worth $2, that really means it's worth $200. And since it is 100 shares, that means $200 can control $10,000 worth of money. Where am I getting $10,000 from? Well, 100 shares times $100 is $10,000. So in this scenario, to have 100 shares of stock, it's $10,000. Here, to control 100 shares of stock, betting on it going to $110 is $200. That's literally a 50 difference. I mean, it's 50 times cheaper to be buying call options versus owning stocks outright. Of course, I will get into the negatives. There is some negatives and risks, but let's keep going here. So the main element about buying call options, which attracts so many people, is important to understand for you, is that one call option is always going to be less expensive than owning the equivalent of 100 shares of a stock, because call options are just always going to be cheaper and they're going to have leverage. They're going to allow you to control 100 shares for a lower price. Now, what we do have to talk about here is that there's going to be a premium on the option. Options are not free, so you don't get to just bet 110 strike without paying some type of premium. So we're going to go over an example of paying a premium, and we're actually going to pull up a real life example of Apple stock. We're going to be looking at Apple call options, and I'm going to show you exactly what a call option on Apple looks like versus just owning outright shares of Apple by itself without having the call option. All right, guys, so check it out. I'm looking at my screen right now, and basically we have an Apple call option here. As you can see, it's a 120 strike, and we can pay $207 to buy basically the rights to 100 shares of the stock. I'm going to explain to you exactly what this means and what the break even is, because it's important to know what you're paying for and what your outcome is going to be. I'm going to explain that right now. So basically, if you're going to buy 100 shares of Apple stock right now, it's at $118 $118.72 right now. So if you're gonna buy 100 shares, you're going to have to pay this amount right here, $118.72. And because we're buying 100 shares, we're gonna put 2 decimal points over. There we go. $11,872 is what you will have to do to buy Apple stock right now, 100 shares, okay? Now with the call option, we're gonna be betting at 120 strike, okay guys? And this costs right here, $207. Notice here that it says a break even of 122.07. The reason it's a break even is because we're adding the strike price, which is $120, plus our premium. So our break even is 122, okay? 122.07. Once the stock reaches this price right here, everything above it is yours. Call options have unlimited upside potential. They continue to go up because it's essentially similar to owning shares, but you have that initial break even point where you have to pay a premium, plus you're betting on a strike price higher than the current strike price. Essentially, I can draw you guys a graph right now. All right, so essentially we have Apple, right? So let's say this is 118, okay? 118.72, okay? Here's Apple stock. It goes up and down, right? As the price here, this is the price, okay? We've made $0. If Apple goes up 10 bucks to this area right here, you earn 10 times 100, which is $1,000, okay? You can earn $1,000 when Apple goes to, this is going to be 128.72, okay? That's Apple stock. It's pretty simple, right? It goes up $1, you make $100 because you have 100 shares. Now let's talk about the call option. With the call option, we talked about having a strike price of $120. So we need to go to at least 120 to start making money. Now, we also have to pay $200, $207, but let's just call it $200, okay? With the call option, you start out right here. Right away, you're losing money because you have to pay a premium. So you're paying $200. You start out at negative 200. Notice that your maximum loss is negative $200. You cannot lose more than what you put into a call option. Okay, so here we have a call option. We spent negative $200. And regardless of how low the stock goes, you see a stock investor can go down all the way to negative $118 times 100 shares. You can lose 11 grand here, or over 11 grand. With a call option, you're stuck here. No matter how low you go, you're always at negative 200, okay? And your break even, again guys, it's the strike price plus the premium. So the strike price was 120, okay? And the premium was $2, okay? Our break even is 122. So somewhere here, okay, 122, call it here, is our break even price. What happens is between 120 and 122, it starts to go up. It starts to go towards break even. Boom, we have broken even. And now you have unlimited upside, just like the stockholder, and you're going up essentially 1 for 1, okay? Here you are. So let's see what actually happens here is when a stock goes up $10, as a stock investor, you earn $1,000, okay? $1,000. As an option investor, when it goes up 10 bucks, okay? This right here, 128.72, we'll just call it 128. 128 minus 122, that is going to be $6, guys. So $6 you make, okay, I'm gonna draw it right here. You make $6 as an option investor and you make $10 as a stock investor, okay? So who made more money? Well, the stock investor made 10 bucks and the option investor made $6. But how much did the option investor invest? And by the way, since it's 100 shares, this is actually $600 and this is actually $1,000, okay? This is $1,000 and that's 600 because again, each option contract is worth 100 shares of stock. So, you know, the stock investor made $1,000, but how much did he have to put in? He had to put in $11,000. How much did the option investor have to put in? He put in $200 and got $600. So you can triple your money as a call option buyer. You can absolutely triple your money. And even more, it can go unlimited. It can keep going. But essentially, I'm trying to paint you guys an example that buying calls, you have a little bit of an initial break-even price. It has to go up by the amounts of premium that you pay plus the strike price. You can play around with the strike price. That's beyond the scope of this video. But essentially, a call option gives you the rights to buy 100 shares of stock. You can leverage your money because you put in so little and you can get out so much. And this is a better way than just owning stock outright in many scenarios. However, we do have to talk about risks. I'm about to get into that right now. Okay, now that you have seen why call options can be so lucrative, I need to explain what expiration means. Expiration, like the old milk in your fridge, is when the contract expires. It is no longer valid. Either as a buyer, you made money or you lost what you paid for the option, which is called the premium, which I just mentioned. Now, the good news and a big benefit to the call buyer is that they can only lose what they paid in to the option. In the case of an Apple call option, as you can see on my screen, you can only lose $207. When you buy calls, your maximum loss is just a premium, whereas if you own 100 shares of Apple stock at the current price of $119, you can lose $11,900. Of course, Apple isn't likely to go to zero, but it was $70 on April 17th, 2020, literally this year, and that was just 6 months ago. So you can lose thousands of dollars, in fact, $3,900 to be exact, if Apple falls back down to $70 per share as a stock investor. As an option investor, it's literally just $200. Now, because all options have a limited time frame and expire every Friday, at least for most stocks in the S&P 500, some stocks expire once a month, which is the third Friday of each month on less traded stocks. You have to be right about a stock's direction, and it has to happen before the expiration date due to a limited time on the option itself. We don't have the benefit of unlimited time frames just like we do with stocks. With options, you have to be right, and you have to be right within a certain time period, and that is one of the biggest risks. So we have some takeaways. We don't have the luxury of unlimited time frame with stocks. With stocks, you can just own them for as long as you like. If they go down, if they go up, it is okay because you can hold them for an indefinite period. Whereas with options, they literally have expiration dates. So not only do you have to be right about the direction, you also have to be right on when the stock does a certain activity. For example, call options can be fantastic for stocks before earnings. However, beware that before earnings, implied volatility is very high. Basically, that's a fancy way of saying that investors are aware that the stock is likely to go up or down a whole lot due to earnings. So there's something called an IV crush, where implied volatility is very high, options are very expensive. Therefore, they could be a good idea to buy before earnings if the stock really does run up. And technically speaking, usually it's quite profitable. However, they are quite expensive. So you do want to be careful before buying a whole bunch of call options, because you could lose your entire premium that you paid, as well as these guys are pretty expensive before earnings. However, I think a great strategy, and certainly a strategy that I was looking at Goldman Sachs, I've done research on, buying calls before earnings, especially on high momentum stocks, is a fantastic idea. So if you're an investor and you're interested in options, buying call options is one of the best ways to get started as an investor. However, buying call options is oftentimes not as profitable in months or weeks where there is no earnings, because stocks are not likely to always be skyrocketing or moving a whole lot during non-earnings dates. So you do want to be aware of buying call options. However, if you're a new investor and you don't have the capital, you don't have $11,000 to buy 100 shares of Apple stock, you could buy 1 or 2 shares of Apple stock, or you can do your research and buy your favorite stocks for a lot less money and control a whole lot of shares. This is a fantastic way to leverage your money. However, it is risky, and I personally do not buy a whole lot of call options. What I personally do is I sell call options. That's what I cover in my course. That is what I'm going to be teaching. And in the next video, I'm actually going to show you guys an example of selling calls. However, in this video, I hope you enjoyed it. If you have any questions, my email is uncle@investwithhenry.com. I'm sending people an email on call options very soon, and I explain a lot of options functionality, and I help stock investors learn more about options, because you can definitely make a whole lot of money investing in options, and it is way more fun and less boring than just stocks, because options allow you to control your income a bit better. They have very defined risk parameters, and they also allow you to aim for specific rewards. I'll show you a lot more of that in the course, but for now, I hope you enjoyed this video, and I have some takeaways for you. Takeaway 1, call options rise when a stock rises. It's a bet on a stock going upwards. It is a very bullish strategy, and you do it on stocks that you like or you think are going to be going up in the short term if you're picking a short-term expiration date on the option. Number 2, buying call options and not options in general are more risky, because you can lose your entire premium, and it is a significant risk because oftentimes options will expire out of the money, and that may happen to you more than 50% of the time, especially if you're picking options with a strike price that is above the current strike price. by definition, that means the option is likely to expire out of the money. It is less than 50% chance that you're going to make money. However, that is okay because oftentimes you can make a ton of money. As I proved here, you can double, you can triple your money. However, you do have to be careful. Number 3, buying call options allows you to buy 100 shares of the underlying stock at or above your strike price. Number 4, you pay premium when you buy calls, and the longer the expiration date, the more premium is on the call option because more stuff can happen with more greater time. Think about it, guys. If you have a Tesla call option 1 week from today, maybe the call option might be pricing in about 5 or 10% move. But what if I said you buy a Tesla call option that is 2 years away? Obviously, the stock can double or triple within 2 years. So that option is going to be a lot more expensive because options traders understand that time is the biggest factor when it comes to investing, and options are priced more the greater the time period is. So that's your takeaways. I'm an options expert, but I'm definitely not an options expert at presenting the material. If you have any feedback or you just want to learn more, do send me an email, follow me on Instagram. Here is my handle. And I'm only 2 weeks away from the course launch, so I'm very excited to teach you guys a lot more. And in the next video, I'm going to show you guys selling call options because I think that is equally or more important to my strategy of making money than just straight up buying calls themselves. Thanks for watching. Peace, people. Be aggressive in learning, but be safe in investing. I'll see you guys in the next video.